How to get a mortgage during retirement. This is actually a pretty good article that someone sent to me that I want to share with you. It's from Mass Mutual of all places, and I actually learned a couple things in this myself. So, look, I don't like mortgages in retirement for sure, but some people are going to get one, and let me go over the pros and cons or the ins and outs of how to do that. So, this is Dateline January 22nd, 2019. So let's see what we got here. Conventional wisdom from Mass Mutual from Amy Fontenelle. All right. Conventional wisdom says homeowners should pay off their mortgage before they retire so they do not have to make a large monthly payment on a smaller income. Yet some retirees might find it more beneficial to keep making their mortgage payment. Consider a couple who sells their home to downsize and receives a chunk of cash from years of building up equity. If they do not use that equity to pay for cash for a new home, they suddenly have significantly more liquidity. They can add that money to the nest egg, invest it, and earn returns that may be higher than what they pay with the mortgage interest. They can then gradually withdraw their earnings for additional retirement income. I just got to take a break there for a second because I always get nervous when financial firms talk about this. And Mass Mutual is a financial firm who would be, I'm telling you, man, you can earn more in the market than your cost of your mortgage. I'm telling you, you got to be careful. It's not about the net return. It's about your cash flow. So I'm telling you, I always get nervous. I'm not saying this lady's doing that, but the fact it comes from Mass Mutual sells insurance. I could easily see them, look, just take the equity out of your home, downsize, use some of the cash to buy this insurance product. Yeah, you can have the mortgage, but it's not paying. You're only paying 3% interest, and you could get 8% on your stocks, whatever. That's scary. Let's see. Withdraw the earnings for additional retirement income. There you go, because you get a higher interest than what you pay on the mortgage. The big question is this: is it possible to qualify for a mortgage after retirement? Financial planners and mortgage lenders say yes. So do Fannie Mae and Freddie Mac. They are government-sponsored enterprises that buy mortgages from banks and home financing companies, provided these mortgages meet certain standards. Under the Equal Credit Opportunity Act, lenders cannot discriminate against borrowers based on age. Retired borrowers, like working borrowers, simply need to show they have good credit, not too much debt, and enough ongoing income to repay the mortgage. Demonstrating proof of income may be different than it would be for working borrowers, though. But retirees who qualify can still take out a 30-year mortgage because lenders cannot base the decisions on the applicant's life expectancy. All right, so mortgage qualifications requirements for retirees. Income. For any mortgage, Fannie Mae instructs lenders to look at income that is stable, predictable, and likely to continue. For borrowers who work and earn a salary or regular wage, that requirement is easy to meet. They can show pay stubs and W-2s that document their earnings history, and they do not need to prove their income is expected to continue at the same level as for the foreseeable future. Not so with retirees. Fannie Mae considers distributions from 401ks and IRAs, savings retirement accounts, to have a defined expiration date because these involve depletion of an asset. Borrowers who derive income from such sources must document that it is expected to continue for at least 3 years after the date of their mortgage application. Lenders can only use 70% of the value of those retirement accounts to determine how many distributions remain if the accounts consist of stocks, bonds, or mutual funds, since those assets can be volatile. The retirees must also have unrestricted access to these accounts without penalty. So if you're before the age of 59 and a half, that wouldn't be applicable here. Social Security income is that borrower is drawing on his or her work record is considered income that does not have a defined expiration date, which would make sense. Retirees can document this income by using their award letter from Social Security. If a borrower does not have to pay taxes on certain income, then lenders can increase that amount by 25%. That's interesting. I didn't know that. They call this grossing up when calculating qualifying income, since other qualifying income sources are considered on a pre-tax basis. So that's good. So if a borrower does not have to pay taxes, i.e. Social Security, then lenders can increase by that amount by 25%. That's good. Just because a lender is allowed to gross up income doesn't mean they have to, says some guy or lady. Some lenders will increase qualifying income by a smaller amount, such as 15%, while others will not do it at all. Corporate or retirement or pension plans is not considered to have a defined expiration date, and nor are part-time job earnings, rental income, or self-employment income. Interest and dividends both fall into that category too, unless the underlying asset produces income that will be depleted. Annuity income can be used to qualify as long as the borrower can document that it is expected to continue for 3 years. Regardless of whether the income has a defined expiration date, lenders require retirees to document the regular and continued receipt of their qualifying income using one or more of the following letters. And she goes through the things about how you're documenting that income. Borrowers who only take sporadic withdrawals from retirement accounts rather than regular withdrawals might have trouble qualifying. Exactly. But the solutions may be easy as long as there's no time crunch to get a mortgage. Just start taking regular withdrawals for 2 months or more before applying for a loan. The solution may be easy as long as there's no time crunch to get a mortgage. Okay, so that's all you got to do is take it for 2 months. All right, and say, look, I took out $3,000 a month. Would they still look at that as a depleting asset? That seems weird to me. Married couples applying for a loan together should consider how their spouse's death would affect their ability to keep paying the mortgage. I completely agree with that because remember, one of the Social Security benefits will go away. Indeed, lenders would be very hesitant to even broach the subject, says this guy, about how you're going to pay for it when one borrower dies. Assets. Retirees also have significant assets but limited income, so Fannie Mae and Freddie Mac have found ways to help retirees qualify based on their assets. Fannie Mae lets lenders use a borrower's retirement accounts in one of 2 ways to help them qualify for a mortgage. If the borrower is already using the asset, the borrower must demonstrate they'll continue to receive regular income from the asset for at least 3 years. If the borrower is not using the asset, the lender can compute how the income stream that would offer. Okay, so they can say, hey, this would pay you 5%, whatever, $100,000, $5,000 a year. Similarly, Freddie Mac changes lending guidelines in the spring of 2011 to make it easier for borrowers to qualify for a mortgage when they have limited incomes but substantial assets. The rule allows lenders to consider IRAs and retirement accounts proceeds from the sale of a business to qualify for a mortgage. These assets must be entirely accessible, and they must be fully vested. Lenders sometimes call this an asset depletion loan or asset-based loan, though it's not a separate loan type, but a way of qualifying. So suppose John's got $1 million in his 401k and has not touched it. He's not yet 75. He's just living off his Social Security and income from a Roth. A lender could use 70% of his 401k balance, or $700,000 minus his down payment and closing costs, to get an amount that he could be expected to use to gradually pay for his mortgage over the next 360 months. All right, that'd give him a $1,700 a month to put towards a housing payment. The lender does not have to subtract closing costs if the borrower pays them from a different account, though. All right. Unfortunately, even if John wanted a 15-year mortgage, the lender would still divide his 401k balance by 360, not 180, because that is what Freddie Mac rules require. That's interesting. So, pretty good stuff there. There's a couple things I did not know about that. Again, I don't like. They don't let you put comments in there. I don't like taking mortgage into retirement. I think that's bad financial planning. But if you know how to do it, you can look around and just make sure you're situated correctly to be able to get one at a good interest rate for sure. Something to know. All right, we'll see you next time.